Tesla Inc. They hope of Tesla's inclusion in the S&P 500 index. Welcome to yet another Equity for Keeps video. We are going to read some piece written here on MarketWatch, as well as this one written on SeekingAlpha. So the header for this says Tesla shares have surged on hope of inclusion in the S&P 500. But does being added to an index help a stock? What happens when a stock gets added to an index? Tesla's stock had a wild ride as investors bet it would join the S&P 500. What happens when a stock joins a benchmark index? It isn't just an academic question. Tesla's shares have surged in recent weeks as observers speculated about whether a fourth straight quarterly profit would put the electric vehicle maker on track to be added to the S&P 500 index. But being added to an equity index isn't such a great thing for most stocks, according to a new working paper. Tulane University's Benjamin Bennett, Zegzi Wang of Lancaster University Management School, and Rainy M. Stools of Ohio State University analyze about 20 years of history and find that while stocks may have benefited from being added to indexes at one time, that has changed in the past decade or so. The positive announcement effect on the stock price of index inclusion has disappeared, and longer run impact of index inclusion has become negative, wrote Bennett, Wang, and Stools. Inclusion worsens the stock price informativeness and some aspects of governance. From 1997 until 2008, they find a stock's price would jump on average 4.7% to 4.9% from the day before the index announcement to 5 or 21 days later. But since 2008, those increases declined markedly to 0.6% to 0.7%. In fact, when the sample period is elongated to one calendar month after the stock is added to the index, the stock sees a decline of 2.1% to 2.3% in the same period since 2008. In the 1997-2008 period, prices increased from 2% to 2.4%. It is worth noting that the latter period they analyzed, the decade or so since 2008, coincides with the enormous investor influx into passively managed funds. Indeed, Bennett, Wang, and Stools note that inclusion in an index by necessity means that the stock will be held by far more passive investors than before. But just as earlier research has found that such an inclusion doesn't increase overall investor demand, the researchers find that holdings by active funds decrease when a stock is added to an index. This implies that when institutional investors tracking S&P 500 index closely, especially passive mutual funds, have to buy newly added stocks mechanically, other institutional investors tend to send their holdings the right. Okay, so before we continue with this, we're just going to add that this is what the data has provided, and it is also always important to note or indicate that the past will not necessarily be the future or the present. So we just have to observe and see whether the current active institutional investors that are involved with Tesla, active funds that are holding Tesla, will sell if it's included in the S&P 500, and if it's included, will the passive ones behave like they have behaved before? And the simple concept about that is that the passive funds, they have by far more money, and when they hold it, they will make an impact. If they hold it and don't sell, then it will just remain stagnant. And if they don't sell, if they're not trading, then nothing's going to happen. If they're not trading, the price wouldn't move. It is only when they trade that if they trade, the prices will fluctuate up and down. So if these guys drown out Tesla shares by accumulating a significant amount of them, already that is the case. A lot of active investors are involved with Tesla. A lot of funds are involved in Tesla, and the shares are not exactly that numerous as such relatively to others. So let's continue. One theoretical outcome of having more passive investors in a stock is that its price contains less information for market participants, the researchers note. That is because prices of individual securities tend to move in line with the other stocks in the index. What's more, owners of passive funds are indifferent to the price of the stock. It is purchased simply because it is part of an index, not on its own merits. The researchers' analysis does confirm that added firms' stock prices do become less informative, in their words. But why does that matter? Existing research suggests that firm managers may use their stock price as a gauge for understanding investment efficiency, whether more capital spending is necessary. For example, an increase in passive ownership of the stock decreases the quality of the governance of the firm, both because passive investors have little incentives to invest in governance activities, and because the increase in passive holdings decreases the potential gains to investors from actively trying to influence a firm's activities, the researchers write. How does those governance change? The analysis shows that after firms have been added to an index, boards tend to use other firms within the same index more as peers for comparison on things like compensation. A firm's investment funding and shareholder payout policies become more correlated with the policies of the index peers. In fact, their work confirms earlier research that finds weak governance goes hand in hand with relying less on private information in favor of replicating public peer policies, they note. The results presented in the paper raise a fresh set of questions, the researchers note. Further research should attempt to explain why and how markets and investors appear to have adjusted to the increase in passive investing, so that the real effects of passive investing have become somewhat weaker. Okay, we're going to cover this one rating here on SeekingAlpha, and it's quite a long one. We're not going to cover everything. We're just going to come out to the top here and says Tesla, the bubble might finally pop. Tesla went from being the least valuable automaker to the most valuable in the world over the last 12 months. Battery electric vehicles Market share is 2% today, but may follow an S-curve adoption rate. Short interest propel the stock higher, but now the short float is only 9%. The lowest since the company's IPO. Industry leading market share, operating margins, and a generous net cash position point to minimal annualized upside. Downside is much more likely at this juncture. S&P 500 inclusion might be a simple buy the rumor, sell the news event. So we're just going to go down here. Okay, here it's pointing out that Tesla's market value has increased by a mind-blowing 704%. We're just going to cover what it says about short squeeze. So it's been long known that Tesla has a cult following. Yes, it has a cult following, no doubt about that. So that is why you can't lump it with it's unique. So when you're doing your research, you have to be careful about what you have in mind, what you're dealing with, which is Tesla. Tesla is not like all those other companies that have been included in the S&P 500 decades ago. Okay, so let's continue to read this. A wide range of investors have piled into the stock, both in institutional and retail. Then add in the possibility of being included within the S&P 500 index, and more investors and speculators have bought into the stock hand over fist. With all of that buying power coming in full force, short sellers have been covering their positions and or receiving margin calls. Then layer in all of the call buying, and the stock enters this virtuous cycle of always trending high. Notice that a substantial portion of this recent rise in the stock price derives from short covering, particularly now that the percentage of short float has declined from 30% last year to around 9%, or the lowest level since Tesla's IPO. And then factor in the implied volatility for options. It's actually mind-blowing. The implied volatility in Tesla shares at their strike price is 76%. That bakes in a ton of premium for options. The only other large cap company that comes close on implied volatility is Wayfair at 74%. So rather than using option strategies, shorting the common way may actually be the cheapest and a bit riskier way to play potential downside in the stock. Let's read a bit about this valuation. We're going to include this link for you to read up. So, but just in case you didn't know what implied volatility means, obviously you know from that the word volatility, you can simply conclude that it is something that has to do with the ease of movement. Yes, the relative ease. So the higher it is, the more it is. So here it says implied volatility does not predict the direction in which the price change will proceed. For example, high volatility means a large price swing, but the price could swing upward very high, downward very low, or fluctuate between the two directions. Low volatility means that the price likely won't make broad unpredictable changes. So with a high volatility, Tesla is probably the highest for a large cap. Then you can expect that a lot of surprises will be there. So it's they also remember this is when, as it concerns options are trading, and it says here, when applied to the stock market, implied volatility generally increases in bearish markets when investors believe equity prices will decline over time. Implied volatility decreases when the market is bullish and investors believe that prices will rise over time. Bearish markets are considered to be undesirable, hence riskier to the majority of equity investors. So we just wanted to bring this piece to you, to your knowledge. It doesn't necessarily mean that will be the case with Tesla, but it's always important to just know about this, and also look forward to what's going to happen, because Tesla is unique, and if it's going to be added, and if it is added to the S&P 500, what will the Tesla look like? Will the cult following change things there for the stock? Would the active funds sell up? And if they do, will the passive funds join in? Will the passive funds resist Tesla because of everything surrounding it? What would they do? We can go around and around the question, and we can't really answer for now. Can't really say anything for now. So, but we just felt that it was really important to bring this piece to your notice, and we're definitely going to include the link. You can see them right down in the description box. Okay. Thank you for watching this video. Subscribe to our channel, hit that notification bell, sign up on our platform, and make very smart use of your money. Our platform is Equity for Keeps. All the links are down in the description box. Thank you again for watching this video.